Disclaimer. This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Before we continue, we'd like to mention that the Luxembourg Fundcast is created and produced by Bertrand Mariot, a practicing regulatory lawyer admitted to the Luxembourg and Paris bars. The mission of this podcast is to bring clear, free, and reliable information sourced from official references that are carefully curated and continually updated and refined through high-standard, evolving prompt engineering on Luxembourg's financial regulation and investment funds to professionals and anyone interested in the Luxembourg Financial Center. Welcome and thanks for joining us today, August 19th, 2025. On this deep dive, we're tackling a really fascinating topic, and actually a very strategic one for any publicly listed company, the share buyback program. Now, you might think of a buyback as, a purely financial transaction, but that's really just scratching the surface. It's actually a remarkably sophisticated instrument. It's core corporate strategy.
Absolutely.
I mean, think about it. A company can use a buyback to fine-tune its capital structure, send a powerful signal of, profound confidence to the market, manage its shareholder mix strategically, and even enhance its earnings per share.
Yeah, there are multiple angles to it.
Exactly.
However,
executing such a program, particularly right here in Luxembourg, which is, let's face it, a premier jurisdiction for these kinds of complex corporate operations, it's an exercise that demands extreme precision.
Oh, definitely.
And rigorous regulatory discipline. It really calls for an intimate mastery of both our domestic corporate law and the overarching European market abuse framework.
That interplay is key.
So our mission today is to guide you through this complex landscape. We're going to focus on three critical takeaways. We think these will give you some clear aha moments and hopefully some actionable insights. First, we'll unpack what we're calling the dual command structure. For a publicly listed Luxembourg company, a share buyback is governed by two distinct but really intricately intertwined legal regimes. You've got the Luxembourg law of August 10th, 1915, which provides the fundamental corporate authorization, the permission slip, if you like.
All right, the power to act.
And then you have the European Union's market abuse regulation, or MR. That dictates the strict process and conduct required to ensure market integrity. Navigating this duality, as you'll see, that's the central challenge.
It really is.
Second, we'll dive deep into the conditional shield of the safe harbor. Now, MAR offers this procedural defense against allegations of market manipulation.
It does, yes.
But it's absolutely crucial, and you understand this isn't some kind of automatic immunity. Far from it. Instead, it demands rigorous, continuous adherence to very strict rules. We're talking disclosure, price, volume.
Very specific rules.
Yeah. And any deviation, even a seemingly minor one, effectively removes this protective shield. That exposes the company and its directors to significant regulatory scrutiny and risk.
The stakes are high if you step outside it.
And third, we'll look beyond legal mechanics. Because a truly successful share buyback program isn't just about ticking legal boxes.
No, it's much broader.
It demands a holistic, integrated approach. It really operates seamlessly at the intersection of corporate finance, where capital is allocated efficiently, tax law, structuring for optimal fiscal treatment, and crucially, shareholder relations, managing expectations, ensuring fairness across the board.
All three pillars are vital.
So we're going to explore each of these areas in, meticulous detail, providing you with a comprehensive guide to the legal and practical framework for share buybacks right here in the Grand Duchy. To kick off this unpacking process, let's bring in our expert.
Thanks. That's an excellent setup, and it really does immediately highlight the core complexity here. What's truly fascinating, I think, is that while the underlying concept, the company buying back its own shares, might seem straightforward at first glance.
Right, simple idea.
Exactly. But it's precisely these intricate layers of regulation and strategic considerations that truly elevate Luxembourg as a premier jurisdiction for these kinds of sophisticated operations. It really demonstrates a profound commitment to market integrity and robust corporate governance qualities that are, highly valued by international investors and corporate leaders.
Mm-hmm.
And as we'll see, successfully navigating this intricate landscape often positions specialized legal and financial professionals not just as advisors, but as absolutely essential strategic partners.
Indispensable, really.
Yes, ensuring not merely compliance, but genuine strategic advantage.
Okay, let's start right at the beginning then. The absolute foundation, the corporate authorization that actually empowers a company to even consider a buyback here in Luxembourg. What's the ultimate legal starting point? The initial permission slip, as I called it?
Well, the legal bedrock, as you put it, is unequivocally the law of August 10th, 1915 on commercial companies, as amended. That's the foundational source of authority in Luxembourg.
The 1915 law. Got it.
Specifically, Article 430-15 of this law, that's the gateway. It explicitly permits a société anonyme, or SA, to repurchase its own shares. And it's particularly important to note how this legal landscape evolved. The 2016 modernization of this law, that introduced significant clarification and, frankly, much greater flexibility for buybacks.
So it wasn't always this flexible.
No, it moved away from some of the more rigid constraints that were in place previously. So this update provided a much-needed level of, well, legal certainty and operational agility for companies.
Okay.
Now, a company can't just decide to buy back its shares on a whim, purely at the board's discretion. There has to be a clear, legitimate corporate purpose driving the decision.
A valid reason.
Exactly. The law implicitly, and market practice explicitly, recognize several such purposes. One of the most common, and indeed impactful, is capital reduction.
Right.
In this scenario, the repurchased shares aren't just held by the company, they're subsequently canceled.
Okay, they disappear.
They disappear. This action directly reduces the company's overall share capital and typically has the effect of increasing earnings per share for the remaining shareholders. It effectively concentrates ownership and potentially boosts those per-share metrics.
Makes sense. What else?
Another vital purpose is to service employee incentive schemes. Companies frequently acquire their own shares to meet obligations arising from employee share or option plans.
Right, stock options and the like.
Precisely. This ensures they have the necessary stock readily available to grant to employees as part of compensation or incentive structures without diluting existing shareholders through new share issuances. A buyback can also serve as a highly tax-efficient method of returning surplus capital to shareholders.
Wow, instead of dividends.
Exactly. It offers a strategic alternative to traditional dividend distributions. This can be particularly appealing for companies looking to optimize their capital allocation and distribute excess cash without triggering the immediate tax liabilities for shareholders that conventional dividends might. And finally, the law does provide for a very exceptional circumstance: avoiding serious and imminent harm to the company.
Wow, that sounds serious.
It is. This is unique because it allows the board to act without prior shareholder approval. However, the threshold for proving such a threat is understandably exceptionally high.
You'd really have to justify that one.
Absolutely. Think of it as an absolute last resort, rarely invoked, but critical as an ultimate safeguard in genuinely dire circumstances.
Okay, that makes perfect sense. So the purpose has to be clear, and the authority comes from Article 430-15. But who actually gives the green light? Is it the board, the shareholders, or some combination? And what does that mean in practice?
It's a clear two-tiered process, very much embodying that separation of powers within a corporation, and it really underscores the importance of proper governance.
Okay.
The ultimate authority rests with the shareholders. The general meeting must pass a resolution explicitly authorizing the buyback program.
So shareholders first.
Shareholders first. And this isn't an open-ended authorization. It's limited to a maximum period of 5 years, though it is renewable.
5 years max.
Right. Crucially, this shareholder resolution must define the precise parameters of the program. That includes the maximum number of shares that can be repurchased and, critically, the minimum and maximum price range within which the company is permitted to transact.
So quite specific then.
Very specific. This level of detail in the resolution provides a clear mandate and sets the definitive limits for the program.
Okay, so the shareholders set the boundaries. What does the board do?
Once the shareholder mandate is granted, the board of directors then takes charge of the execution. The board implements the program strictly within the framework that the shareholders have approved. This involves deciding on the precise timing of the launch, the method of execution, whether it's on-market purchases or maybe something else, and ensuring unwavering compliance with all the legal and regulatory constraints throughout the buyback period.
So the board handles the how and when within the shareholders, what and how much.
Precisely. And the drafting of that initial shareholder resolution, therefore, is far from just a formality. It's a deeply strategic document.
How so?
Well, a broadly defined mandate affords the board maximum tactical flexibility. It allows them to respond nimbly to fluctuating market conditions, like sudden price drops or changes in trading volumes.
So they can adapt.
Exactly. Conversely, a very narrowly defined mandate reflects a desire for tighter shareholder control over the process, limiting the board's discretion.
More oversight.
Right. The art of sophisticated legal counsel here truly lies in balancing that need for operational agility for the board with the imperative of adhering strictly to the delegated authority from the shareholders. It's about finding that sweet spot between empowerment and oversight.
That's a really insightful distinction, balancing flexibility and control. So once a company has this authorization, this mandate, what are the inherent legal guardrails? Are there specific tests or principles that act as sort of non-negotiables to protect the company itself or maybe its creditors?
Absolutely. There are several core legal constraints that act as vital safeguards, ensuring the financial health of the company and protecting its stakeholders. The most important of these is the net asset test.
The net asset test, okay.
It's codified directly within Article 430-15 itself. This critical safeguard mandates that a buyback cannot cause the company's net assets to fall below the sum of its subscribed capital and its non-distributable reserves.
So you can't dip into the core capital.
Exactly. In essence, this means buybacks must be funded exclusively from distributable profits or available reserves, never from the core capital that creditors rely upon. It's an ironclad guarantee that prevents a company from distributing capital in a way that would jeopardize its financial solvency or unfairly prejudice its creditors. It ensures the company isn't essentially buying itself into financial trouble.
Makes sense. Crucial protection. What else?
Another cornerstone is the general principle of equal treatment of shareholders. Fairness, fundamentally. It requires that any acquisition offer must be made on the same terms to all shareholders who are in the same position.
Okay.
However, the modernized law provides for crucial and practical exceptions, especially important for listed entities.
Okay. Exceptions are important here.
Very important. This principle can be waived by a unanimous decision of a general meeting where all shareholders are present or represented. But more importantly, for public companies, the law explicitly permits a company to repurchase its shares directly on the stock exchange without making a formal offer to all shareholders.
They can just buy on the market.
Yes. This on-market approach is by far the most common and practical method employed by public companies. It allows for efficient execution without the massive complexities and administrative burden of trying to make a universal tender offer to every single shareholder.
Right, that would be incredibly difficult. So that distinction between the general principle and the practical exception for on-market buybacks is really key for public companies. Well, let's say the shares are acquired, they're back with the company. What happens to them then? Do they still count? Do they have voting rights? How are they treated on the balance sheet?
That's a great question because once repurchased, these shares enter a unique state. They're designated as treasury shares.
Treasury shares.
Right. And critically, the voting rights attached to these shares are automatically suspended.
No voting.
No voting. This means they cannot be exercised while held by the company, preventing the company from voting on its own affairs, which would clearly be a conflict of interest. The board also has the discretion to suspend their dividend rights, further emphasizing their unique status.
Okay, so no voting, maybe no dividends. What about the accounting?
Well, should these shares be held on the company's balance sheet as an asset, an equivalent unavailable reserve must be created on the liability side.
An unavailable reserve. Okay, what does that do?
It might sound like a technical accounting trick, but it's a critical safeguard. It essentially locks up an equivalent amount of capital on the balance sheet. It ensures that funds used for buybacks aren't mistakenly distributed as dividends later on.
It prevents double dipping, sort of.
Exactly. This accounting measure is essential to maintain balance sheet integrity. It reflects the fact that these funds are tied up in the company's own shares and are not freely distributable to other shareholders. It's a key protection for creditors and for the overall financial health of the company.
Right. Okay, this is where it gets absolutely fascinating, I think. We've laid out the corporate permission slip from Luxembourg law, the internal mechanics. But for public companies, the market itself is a whole different rule book. So how does European law, specifically the Market Abuse Regulation, MAR, really dictate how these buybacks are conducted on the open market? Because this is where theory meets the very real, very immediate world of daily trading.
Indeed. That's precisely where the critical interplay happens, and it's arguably the most demanding part of the process for listed entities. While Luxembourg's corporate law provides the permission to act, It is European law that dictates the conduct in the market. particularly for any issuer with securities traded on a regulated market within the European Union. For these entities, the Market Abuse Regulation, MA, is the definitive rulebook.
Okay.
And its core purpose is absolutely clear and fundamental to healthy markets. Protect market integrity by prohibiting practices like insider dealing, unlawful disclosure of inside information, and, most relevant for us today, market manipulation.
Right. Manipulation is the big concern with buybacks.
Exactly. The inherent challenge with a share buyback is that it involves an issuer trading in its own securities. Without a robust framework, such activity could easily be perceived as having the potential to manipulate the market, artificially influencing prices or volumes.
So how does MA handle that?
This is where Article 5 of MA steps in. It provides what is known as the safe harbor.
The safe harbor, I mentioned that earlier.
Yes. This is a conditional exemption from allegations of market manipulation. Adherence to the specific conditions of this safe harbor creates a powerful legal presumption that the trading activity is legitimate and not manipulative.
A presumption of legitimacy. That sounds valuable.
It's a powerful shield, but it is, as you said earlier, conditional and must be diligently maintained.
Conditional. Okay. Is using it mandatory?
No, and that's crucial to understand. Using the safe harbor is a choice, not an obligation. A company may choose to operate outside its confines.
But why would they?
Well, they might have specific reasons, but in doing so, they immediately forfeit that critical presumption of legitimacy. They expose themselves to a significantly higher level of regulatory scrutiny should their trading patterns ever be questioned. The burden of proof would shift dramatically, making any defense much more difficult.
Right. So it's generally safer to be in the safe harbor.
Generally, yes. The technical standards and the granular, detailed rules for operating within the safe harbor are meticulously laid out in Commission Delegated Regulation EU 2016-1052. And these rules are not optional suggestions. They demand absolute, meticulous compliance.
Okay, so the safe harbor isn't a free pass. It's a set of rigorous requirements. Can you walk us through the most demanding of these conditions? What are the key areas where companies absolutely cannot afford to slip up if they want that shield?
Absolutely. Think of these as the pillars holding up the safe harbor. First, there are stringent disclosure and reporting obligations.
Transparency.
Transparency is paramount. Before any trading under the buyback program commences, the company must make a public disclosure. This disclosure has to contain the full details: its explicit purpose, the maximum monetary value allocated, the maximum number of shares intended to be acquired, and the precise duration of the program.
All up front.
All up front. This initial announcement sets the stage, telling the market exactly what the company intends to do.
Okay, what else?
Following this, during the execution phase, every single transaction carried out under the program must be reported to the competent authority, which in Luxembourg is the Commission de Surveillance du Secteur Financier, the CSSF.
Every single trade.
Every single one. And this reporting needs to occur no later than the end of the 7th daily market session following the trade. The CSSF manages this reporting process efficiently through its electronic portal known as Erase.
Erase.
And it's not just private reporting to the regulator. These same transaction details must also be disclosed to the public within that same 7-session time frame, and they have to remain prominently available on the issuer's website for at least 5 years.
Wow, dual reporting. That's significant.
It is. This dual reporting stream ensures broad transparency, allowing regulators and the public to monitor the buyback's compliance, essentially in real time.
Okay, disclosure and reporting. Pillar 1, what's next?
Pillar 2, strict price and volume conditions. These are specifically designed to prevent artificial market distortion.
Right, stop the company manipulating its own price.
Precisely. To prevent a company from artificially inflating its own share price, it is explicitly prohibited from purchasing shares at a price higher than either the last independent trade or the highest current independent bid on that specific trading venue.
So they can't lead the price up.
They cannot lead the market upwards. They must buy at or below existing market levels. Furthermore, to prevent a company from dominating the market in its own stock and distorting trading volumes, its daily purchases on any single day cannot exceed 25% of the average daily trading volume of its shares on that venue.
25% daily limit.
Yes, and that average is typically calculated over the preceding 20 trading days, providing a clear benchmark. This 25% rule is a critical guardrail against market dominance and ensures a natural market price discovery process isn't overwhelmed.
Got it. Disclosure, price, and volume was the third pillar.
Third, there are explicit trading restrictions. These are quite specific. Throughout the entire life of the buyback program, the issuer is prohibited from selling any of its own shares.
Only buying, no selling.
Only buying. The program is solely for acquisition, not for active trading. Furthermore, no trading is permitted during a closed period.
Before results announcements.
Exactly. This is precisely defined under Article 19-11 of NR as the 30 calendar days preceding the announcement of an interim or year-end financial report. This isn't just a calendar entry, it's a fundamental principle of fairness. It prevents the company trading with information that's about to become public.
Makes sense. Avoid insider trading vibes.
Precisely, ensuring no one gains an unfair advantage right before major financial news breaks. Lastly, and perhaps most fundamentally, trading is absolutely forbidden if the issuer is in possession of undisclosed inside information related to its shares. This aligns with the broader principles of market integrity, ensuring a level playing field for all investors.
Okay, that's an incredible level of detail and control. Disclosure, price limits, volume limits, no selling, closed periods, no trading on inside info. It sounds like the operational burden of complying with all these MAR rules would be, well, immense for a company trying to manage it internally.
You've hit on a critical point. The operational burden imposed by these MAR rules is genuinely significant. It requires daily, sometimes even minute-by-minute, monitoring of trading volumes across relevant venues.
Wow.
Constant price checks against real-time market data, and the meticulous management of those dual reporting streams to both the CSSF and the public. This demands dedicated systems, specialized expertise, and robust internal controls that many companies, especially those not primarily in finance, simply don't have readily available.
So how do they handle it?
Well, for this reason, it has become standard market practice and in many cases a practical necessity for listed companies to delegate the actual execution of the buyback program to a single independent financial intermediary.
Like a bank or a broker.
Exactly. A reputable bank or a specialized brokerage firm. The mandate agreed upon with this intermediary is a critical legal document. It must contain provisions that ensure the intermediary makes its trading decisions concerning the timing and execution of purchases independently of and without day-to-day influence from the issuer.
That independence is key, right?
It's not just good practice, it's a vital feature. It provides an additional layer of protection against allegations of manipulation and is actually a specific condition for certain exemptions from the general trading restrictions under MR to apply. It ensures the trading is driven by market conditions, not potentially by undisclosed corporate knowledge.
So you hand off the day-to-day buying and reporting.
You hand off the operational execution. But, and this is crucial, while this delegation effectively transfers the operational risk of day-to-day execution and the complex logistical burden, the ultimate legal responsibility for overall compliance with the MR framework remains squarely with the issuer's board of directors.
So the board can't just wash their hands of it.
Absolutely not. They cannot simply outsource their accountability. It's their responsibility to choose a reputable intermediary, ensure the mandate is robust, covers all the bases. But the buck ultimately stops with the board.
That distinction between operational delegation and ultimate legal responsibility is crucial.
Yeah.
So now that we understand the legal and regulatory framework, the Luxembourg Law, permission slip, the MAR rulebook, let's turn to the practical side. For someone actually navigating this process, from that initial strategic thought to the final execution, how does a share buyback program truly unfold in practice? What are the key stages, the sort of timeline, and what are the crucial documents involved in this very precise choreography?
Precisely. It truly is a multi-stage process, a carefully choreographed dance underpinned by precise legal documentation at every single step. The typical chronology begins well before any trading happens. It starts with the board of directors' deliberation. This is where the strategic why is thoroughly debated. Is it aligned with broader corporate objectives? Then a formal proposal is meticulously prepared for the shareholders. This initial strategic phase is absolutely pivotal. It sets the tone and purpose.
Strategy first.
Strategy first. This leads directly to the general meeting where the shareholders cast their votes on that authorization resolution we discussed. This vote is the cornerstone, setting the definitive legal boundaries and parameters, empowering the board within clear limits.
Shareholder approval secured.
Right. Once that mandate is secured, the company proceeds with the selection and contracting phase. They select a financial intermediary. This involves rigorous due diligence, choosing a partner with the necessary expertise, the right systems, followed by formalizing the relationship through a comprehensive legal agreement, the mandate.
Pick your partner carefully.
Very carefully. Following this, the board makes a formal launch decision, passing a resolution to officially commence the program. This critical internal decision then triggers the public announcement.
The MAR disclosure we talked about.
Exactly. The ad hoc disclosure under MAR that, as we discussed, must be published before any actual trading begins. Pre-trading transparency is paramount. It tells the market what's coming.
Okay, announcement out. Then the buying starts.
Then comes the execution period. During this time, the selected intermediary actively repurchases shares on the market, strictly adhering to all those predefined price and volume limits stipulated by MR. Throughout this period, the company diligently fulfills its ongoing reporting obligations, reporting every trade to both the CSSF via ERISE and to the public. Continuous transparency and compliance.
Keeping everyone informed.
Yes. The program then concludes either upon reaching its specified target, maybe the maximum number of shares, or the maximum money spent, or upon the expiry of the initial authorization period, usually 5 years max, whichever comes first.
Okay, program finished. What happens then?
Finally, post-program, the board makes a pivotal decision regarding the fate of those repurchased treasury shares. If the decision is to cancel them, which is often the case for capital reduction purposes, a formal capital reduction process is required.
More paperwork.
More paperwork and a formal legal step. This process must be formalized through a notarial deed to amend the company's articles of association, making the change legally binding and public record.
Right, got it. That's a very clear roadmap. Now, let's zoom in on those critical legal documents you mentioned. The shareholder resolution, the public announcement, the mandate with the intermediary. What are their absolute core components, and why is their precision so incredibly important? It sounds like even a small oversight could potentially unravel the whole thing.
You're absolutely right. Precision in these documents isn't just about good practice. It's about mitigating fundamental legal and regulatory risk. Getting them wrong can have serious consequences. The general meeting resolution is, as you highlighted, the very cornerstone of the entire operation. Its core clauses have to be meticulously drafted to be comprehensive.
Okay, what needs to be in there?
First, an authorization clause. This explicitly empowers the board of directors to act, specifically referencing Article 430-15 of the law of August 10, 1915. This clause is the direct source of their legal power. Second, a parameters clause. This is incredibly important for setting the boundaries. It must precisely specify the maximum number of shares that can be acquired and, crucially, the exact minimum and maximum price range for those acquisitions. Clear boundaries for execution.
Max shares, min-max price. Clear.
Third, a duration clause stating the authorization is granted for a specific period not exceeding 5 years. This sets the time limit. The board can't just do this indefinitely without going back to shareholders. And finally, a purpose clause, clearly defining the intended use of the acquired shares. Is it for capital reduction? To service employee incentive schemes? Something else? This clarity helps ensure alignment with strategic objectives and act as a check against misusing the authorization.
Authorization, parameters, duration, purpose. Got it. What about the public announcement?
The public announcement, that ad hoc disclosure, is equally critical for market transparency. This document must perfectly mirror the parameters set in the shareholder resolution. No discrepancies allowed.
Consistency is key.
Absolutely. It must explicitly state the program's purpose and unequivocally confirm that it will be conducted under the conditions of the MAR safe harbor. This announcement serves as the foundational public document. Everything that follows is measured against it by regulators and the market. It's the market signal buyback underway, following specific rules.
Okay. And the third one, the mandate with the broker.
The mandate with the financial intermediary. This is a critical risk management tool. You really can't overlook it. It must contain several key provisions.
Like what?
An independence clause. This is vital. It affirms the intermediary will make its trading decisions, timing, execution independently of and without influence from the issuer.
We discussed that independence earlier.
Yes, and it's crucial here in the contract. It's not just best practice. It's vital for qualifying for certain MAR exemptions, ensuring the intermediary isn't seen as acting on inside information or manipulatively. Then, a compliance clause. Here, the intermediary formally undertakes to comply strictly with those price and volume limits from Article 3 of the Commission delegated regulation we mentioned. This embeds the MR safe harbor requirements directly into their operating mandate. It makes them responsible for adhering to the technical specifics.
So they promise to follow the MA rules.
Exactly. And finally, a reporting clause. This obliges the intermediary to provide the company with detailed and timely transaction data. This is crucial because it enables the company to meet its own ongoing reporting duties to the CSSF and the public. Without that timely, accurate data feed, the company would struggle to maintain its transparency obligations and could risk falling out of safe harbor compliance.
Independence, compliance, reporting. Makes sense.
Yep.
Okay, that breaks down the documentation beautifully. It's clear that legal precision is absolutely paramount. But beyond the standard sort of on-market execution, we know the art of the deal often involves complex negotiations, doesn't it? Especially with significant shareholders. And of course, every strategic move like this comes with a cost. What should our listener know about these more nuanced practicalities, the negotiations, the pricing, and the full spectrum of costs involved?
This is truly where the strategic and the relationship management aspects really come into play. We move beyond pure legal compliance into the realm of corporate finance and stakeholder management. Beyond the straightforward on-market programs, buybacks can indeed involve highly complex negotiations, especially, as you say, when a company has a significant reference shareholder.
Like a founder or a BPE fund.
Exactly. Let's consider that common scenario. A company with a founding family or a strategic partner holding a major, perhaps even controlling stake. A key negotiation point in that situation would often be whether this reference shareholder will participate in the buyback on a pro rata basis.
Pro rata, meaning in proportion to what they already own.
Precisely. In proportion to their existing holding. This is a common arrangement specifically designed to maintain their exact percentage ownership and thereby preserve the existing balance of power and control within the company.
So they don't accidentally increase their stake relative to others.
Exactly. Without such an arrangement, their stake would effectively increase as the total number of shares decreases, potentially altering governance dynamics, which could lead to friction.
Okay, pro rata participation.
Yeah.
What if the company wants to buy a lot of shares back quickly?
Good question. If the desired volume of shares for repurchase is exceptionally large, executing the entire buyback through an open market program might prove too slow or, frankly, too disruptive to the market. It could cause unwanted price volatility. In such instances, the negotiation might shift towards arranging a large, off-market block trade.
A private deal for a big chunk of shares.
Essentially, yes. And pricing such a block trade is a truly delicate art. The price has to be demonstrably fair to all parties involved. It's often meticulously linked to a recent volume-weighted average price, or VWAP, on the public market.
VWAP, the average price over a period.
Exactly. VWAP isn't just jargon. It's the average market price weighted by volume over a specific recent period. For a block trade, linking the price to VWAP is crucial to defend against any future claims of preferential treatment for the participating shareholder. It ensures transparency and equity. It's like saying, look, we're paying what the market generally agreed was fair recently, preventing accusations of sweetheart deals.
Okay, that makes sense for big negotiated trades. Now, what about the cost of all the advice needed for this? The lawyers, the bankers?
Right, the advisory services themselves, which can be a significant cost component. There's a range of approaches here. While traditional hourly rates are certainly still prevalent.
The ticking clock.
The ticking clock, yes. Fixed or capped fees have become quite common for more standardized buyback programs. This offers companies a welcome degree of cost certainty, allowing them to budget effectively for that advisory component.
Predictable costs are good.
They are. However, for highly complex structured buybacks, perhaps those intricately linked to a major M&A deal, or those involving a highly specialized tax-optimized share class redemption, a value-based fee may be more appropriate.
Based on the value created.
Exactly. This type of fee structure reflects the strategic rather than purely procedural nature of the advice being provided. It acknowledges the significant value created by complex structuring that goes far beyond simple legal drafting or process management.
Yeah, it's a critical distinction in fee structures, reflecting the complexity.
Yeah.
Okay, when we consider the full picture then, what are all the different direct and indirect costs that a company really needs to account for when planning a share buyback? Because it sounds like it goes far beyond just the price of the shares themselves and the broker's commission.
You're absolutely right. It's considerably more than just the direct cost of purchasing the shares and the brokerage commissions paid to the financial intermediary. Companies need to factor in the full spectrum of costs.
Such as?
Well, first, there are substantial advisory costs. Fees for legal, tax, and financial counsel. These experts are crucial for navigating the intricacies of corporate law, MAR, the often complex tax implications, ensuring the program is both compliant and optimally structured. This can involve many, many hours of senior-level consultation.
Legal and tax advice, big-ticket items.
Often, yes. Beyond this, there are administrative and regulatory costs. These include, for example, notary fees for any subsequent capital reduction that requires an amendment to the Articles of Association. That's a mandatory step that comes with specific fees. There are also fees for mandatory public announcements to comply with transparency regulations.
Notary fees, announcement fees.
Okay. And finally, a factor often underestimated, the internal costs.
The company's own time.
Exactly. The substantial commitment of time and resources by the company's own internal legal, finance, and investor relations teams. While it's not a direct cash outlay on an invoice, this is a significant internal investment.
How significant?
Well, imagine potentially hundreds, even thousands of hours from senior finance and legal personnel dedicated to the planning, the coordination, the daily monitoring we discussed, the intricate reporting. This includes setting up internal systems, managing data flows from the intermediary, reviewing disclosures meticulously, handling investor queries. It's practically a full-time job for a dedicated internal team during the buyback period. Neglecting these internal resource costs can lead to significant strain on operational efficiency elsewhere in the business.
Wow. That really paints a comprehensive picture of the resources involved, far more than just writing a check for the shares. So, okay, we've dissected the legal framework, the practical execution steps, the documentation, the costs, the negotiations. But what does this all mean for Luxembourg's competitive position on the global stage? Because you mentioned earlier, and the outline notes, there's been a pivotal recent development that truly enhances its appeal for sophisticated corporate structuring. Can you illuminate this for us? Really explain why Luxembourg shines in this specific context, especially now?
Absolutely. This is where Luxembourg's distinct advantages truly converge and become highly compelling, cementing its reputation as a sophisticated financial center. A pivotal recent development that has profoundly enhanced Luxembourg's appeal, especially for sophisticated corporate structuring, is directly tied to the tax measures for 2025.
The 2025 tax changes.
Yes. These measures came into effect earlier this year, and they are current as of today, August 19th, 2025. And they provide really welcome clarity and certainty to the tax treatment of certain types of buybacks.
Okay, what's the key impact?
The key impact is a highly favorable tax treatment for share class buybacks. The law now formally codifies that the repurchase and subsequent cancellation of an entire class of shares can be treated as a partial liquidation.
An entire class of shares treated as partial liquidation. What's the significance of that?
The profound significance of this legal codification is that such a transaction is not subject to the standard 15% dividend withholding tax.
No 15% withholding tax. That's huge.
It is a potential game changer for specific types of corporate restructuring, particularly those involving distinct investor groups holding different share classes, or for strategic capital realignments.
Are there conditions? It sounds too good to be true.
Oh, yes. There are rigorous conditions. This favorable treatment isn't automatic. For it to apply, the entire share class must be canceled.
The whole class has to go.
The whole class. Furthermore, this share class must have had distinct economic rights, different voting rights, dividend rights, liquidation preferences, whatever, that were clearly defined in the company's Articles of Association right from its inception.
So it had to be a genuinely different class of share all along.
Exactly. And critically, the redemption price must reflect fair market value. This ensures the transaction is conducted on arm's length terms and isn't just a disguised distribution trying to avoid tax.
Fair market value. Okay. How did this work before the new law?
Well, previously, this specific tax treatment relied heavily on administrative practice and evolving case law. While it often yielded favorable outcomes, it inherently carried a degree of uncertainty. You might need rulings, there is interpretation involved.
Less certainty.
Much less certainty. This new legal codification transforms what was a potentially contentious structure, or at least one requiring careful navigation, into a reliable and predictable strategic tool. It significantly de-risks these kinds of operations.
That is a genuinely massive development, especially, I imagine, for private equity funds and companies with multiple classes of shares. It transforms an area of potential ambiguity into clear certainty.
Absolutely. It's a major enhancement.
So to really crystallize this for our listeners, how does this new tax clarity, combined with everything else we've discussed, the modern corporate law, the robust MAR implementation, how does this create Luxembourg's unique value proposition? Why is it becoming or solidifying its position as the go-to for these complex buyback strategies?
It's precisely this confluence of factors that defines Luxembourg's unique value proposition. This new tax clarity isn't just a minor tweak, it's a real structural advantage. It makes Luxembourg potentially the go-to jurisdiction for strategic exits and capital adjustments involving share classes. Imagine, as you said, a private equity fund. They've invested in a specific class of shares, maybe preference shares, within a Luxembourg company for several years.
Yeah.
Previously, exiting this investment via a company buyback of that specific share class might have involved complex tax planning, maybe intermediary holding companies, rulings, all to mitigate potential withholding tax risks.
A lot of hoops to jump through.
Exactly. Now, with this legal codification, they have a clear, predictable, and highly efficient path to retrieve their capital without triggering that standard 15% dividend withholding tax, provided all conditions are met. This can potentially save millions in tax liabilities, making Luxembourg an exceptionally attractive hub for investment and divestment strategies, especially for funds with complex capital structures involving multiple share classes.
That makes perfect sense. It really sharpens the edge.
It does. And this entire development encapsulates Luxembourg's powerful synthesis of strengths. First, the Grand Duchy offers that modernized and flexible corporate law, the 1915 law as amended, particularly post-2016, which consistently provides the necessary legal tools for complex transactions. It gives companies the framework to act.
The foundation.
The foundation. Second, it boasts a robust and trusted regulatory environment. It fully implements the EU's MAR framework, ensuring paramount market integrity and investor protection. This compliance fosters confidence among international investors. They know transactions are conducted under a strict, harmonized European standard.
Predictable rules.
Predictable, high standards. Third, and now significantly enhanced, is its offering of enhanced tax certainty, particularly with this share class buyback rule. This is highly prized by international investors and corporate planners who seek efficient and predictable fiscal outcomes, reducing the scope for unwelcome surprises down the line.
Certainty is valuable.
Extremely valuable. And finally, all of this is underpinned and supported by a deep ecosystem of highly specialized expert legal, tax, and financial advisors, people who routinely execute precisely these kinds of complex cross-border operations. This integrated approach, combining sophisticated legal frameworks, robust regulation, tax clarity, and a deep pool of expertise, is why Luxembourg continues to be a premier hub for sophisticated financial activities and a destination of choice for companies undertaking complex share buyback programs.
That's a fantastic summary of Luxembourg's edge. Okay, here's where it really gets interesting for you, our listener, and hopefully brings those aha moments into focus. As we bring this deep dive to a close, let's just quickly revisit those 3 key takeaways, crystallizing what we've learned and offering a final thought to ponder. First, remember the dual command structure. A share buyback gets its permission under Luxembourg's domestic corporate law, the power to act. But its execution in the public market is meticulously policed by the European Union's Market Abuse Regulation, MAR. So, the power is local. The strict rules of engagement are distinctly European. Mastering both is absolutely non-negotiable.
Both matter equally.
Second, the MR Safe Harbor is a conditional shield, remember, not a blanket immunity. It requires meticulous, continuous compliance with its strict rules on disclosure, price, and volume. This isn't a passive benefit you just get. It is a defense that must be actively earned through unwavering procedural rigor and constant attention to detail. Any misstep can cost you that critical protection.
You have to stay vigilant.
Exactly. And finally, a share buyback is truly a multifaceted strategic decision. It is not merely a legal process or just a simple financial transaction. It's a sophisticated act of capital allocation that demands a holistic view, seamlessly blending the disciplines of corporate finance, astute tax planning, and thoughtful shareholder relations. Mastering these interconnected principles is the absolute key to executing a successful, compliant, and genuinely value-enhancing share buyback program right here in Luxembourg.
And perhaps building on that, a final thought to consider is the dynamic nature of all this. The continuous evolution of both domestic corporate frameworks like the Luxembourg Law and pan-European regulations like MAR means that while the core principles we've discussed today remain foundational,
The ground keeps shifting a bit.
Exactly. The nuances of execution will always shift and demand constant adaptability. For professionals operating in this dynamic space, the ability to synthesize these complex layers of regulation and strategic considerations, and to adapt quickly to new developments, often, frankly, with the indispensable guidance of specialized legal and financial partners, well, that ability is not just a competitive advantage anymore.
It's essential.
It's really a foundational requirement for sustained success in Luxembourg's dynamic financial center. The landscape never stands still, and neither can your understanding or your strategies.
This podcast is meant to be a collaborative, free resource that improves over time, so your comments or requests for new topics are highly welcome, especially on YouTube. We want to be a helpful strength for everyone working in the Luxembourg Financial Center at all levels. We are often asked how you can help us. Well, a great way to help is by subscribing to our shows on all major podcast platforms, including Spotify, as well as on Apple Podcasts, where a 5-star rating would really help us. You can also like our videos and subscribe to our Rigore Media YouTube channel. All relevant links will be available in the show notes. For our French-speaking listeners, you can also find our sister podcast in French. It was the Luxembourg Fundcast for you today. Disclaimer. This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance.